Good morning, YouTube. This is TerrenceRe, and I got another stock market update for you. In this video, I'm going to go over some technical analysis for the week. We're going to go over some of the FANG stocks, and we'll talk about big news that's affecting the market today and what to look for the week right after the buffer. So right now we got the basically the market is flat. We got the VIX futures sitting right at down 2%, which is basically flat for this market. The S&P 500 futures up what 0.5%. Nasdaq futures they opened down a little bit. I did a little bit of scalping this morning. Uh, Lost a little bit of money, not a whole lot. I was actually up and then got back in. And I decided to just come out. Nasdaq futures basically flat. Dow futures up 1%. And the Russell futures is basically flat. You see, you're looking at my watch list. I'm just going down. That's what I look at every morning. I got the bonds down 1%. Notes are down 0.5%. And, the oil futures are down almost 8%. So we got gold futures down 1%. Bitcoin holding steady, up about 1.5% in Bitcoin, which is really, might as well say flat for Bitcoin. That's not a whole lot of movement because it can really move. The 10-year yield is up 5%. Uh, that's a significant move there. The financials are up. So, the banks are up 2%. XLE, which is energy, is down 2%. And basically the major news that we had I think released yesterday with Apple being down 1%. I think it was down a little bit lower when it opened up, and it looks like it's getting ready to fill the gap. So I'm looking at a weekly chart right here. So let's drop down and let's go to we're gonna go down to a 1 minute, right? And I just want to show you, looking at a 1 minute chart when I'm talking about filling the gap. This is what I'm talking about. So the market in Apple, this is the opening print right here at 9:30. So it opened down, what is that? Right around what 150, 152, right around there. And at the close on Friday, it was at, I don't know, what is that? Somewhere around 154.75, something like that. If I want to be exact, I could just click over here and then look. Um, but that's good enough. So it opened down about $3. And as you can see from here, it's just been going sideways a little bit to up. And that's what I mean by filling the gap. So it looks like it's fighting its way back up to fill this gap right here. And that's what I mean by filling the gap. And so the news was there was a surge in COVID-19 cases that led to Chinese manufacturing hubs in Shenzhen. And I may be mispronouncing these, but Changchun to lock down in recent days. So it halting production at many electronics and auto factories and the latest threat to the world's battery supply chain. So they got a surge over there, and basically in China it says while China's case numbers are tiny by global standards, the country has adopted a zero COVID policy. So they, any little slight lockdown or any little slight rise in cases, they just shutting everything down. So Apple, they provide Apple with a lot of I think with some of their chips or some of their main factories over there. And so I, just reading this, and I'm on my TD or my Thinkorswim app. The disruption in Shenzhen came less than a week after Apple showed off new products, including the latest version of its budget iPhone SE. A shortage of electronics has contributed to a rise in prices around the globe, including in the US, where inflation in February hit a 40-year high of 7.9%. And so, that's why you see a lot going on with the energy markets, where you're seeing what oil had the big jump. When we zoom back out and go to the daily, you'll see that when we look at the daily on oil, this is where you see the big spike right here on some of those news, some of the when with the war and this, that, and the inflation numbers. So you seen the spike in this print up to like 130 oil. So that's why a lot of us seeing, a little what they call pain at the pump. But it looked like it hit these highs and then now it's falling back down. So today, oil is dropping. It's dropping like a rock, down about currently 8%, moving towards 9%. If I had to get just doing basic analysis, I would say like right here, right around 96 may be where it stops at. So dip buyers in oil, you say you can buy the oil futures, right? So you could come in here and do like a call spread or sell a put or something like that. Be careful when trading something like oil futures. I would not trade these naked. I would do spreads. If you want to come in here and buy the dip in oil and say you believe I would be somewhere in here where I would think that it will find support. And if you wanted to come in here and do something like I would come in here and do a call spread if I wanted to trade oil, right? If I wouldn't, you see, you only got 3 days in this contract. So I would come out in this next month contract, 31 days. And if you wanted to do something, I possibly would come in here, maybe buy one here in the money, maybe come right here, buy the 98, sell the 99, and do it for something like that. But right here is costing you to do that. Max profit would be right around 630. Let me lock it in so it stop moving. 610, max loss would be 390. So you'll be paying $390 for this spread. That's 0.90 times 10 at $10 a tick. You'd be paying $390 for the spread, and you'd be trying to make a max profit of 610, which I wouldn't hold to try to get it all. Try to get about 50% of this and then close it out. So that's something you could do on oil futures if you wanted to buy the dip, right? Um, Make sure you know exactly what you're doing when you're trading something like that's a big contract. So that's just one thing. But the main thing I wanted to talk about was, so you remember, if you guys remember, well, it ain't been that long ago. It may seem like decades now. It was just easy to just buy the dips in the bull market, right? I'm gonna bring up a chart of the SPX, the S&P 500. I'm gonna zoom out to the weekly, and then I'm gonna go out about 3 years. So basically, this is a 3-year chart. We're just looking at here, and each one of these candles is a week. So it was easy to just come in here and buy this dip. Every time you get a little down move, you just buy the dip and hold it. So everyone looked like geniuses. It looked like everyone could trade. People was, had Robinhood accounts going crazy. And so now, when you think about it, we haven't had that much of a downturn. It seems like a lot, but it really isn't. The market, in all actuality, in my opinion, should be somewhere down here anyway. This is where the Federal Reserve came in and really they stepped into the bond market, and they actually started what some would call on the street picking winners and losers. You know, they stepped into the market and was purchasing debt for major companies as well. And so you see the whole market going up. Uh, and then all this is stimulus, PPP money, and a bunch of other, and a bunch of other things causing the market to go up. So now all of these things catching up with the market, causing inflation, and then you put that on top of that, you got this war. And so that's you seeing a little bit of a pullback. Well, me being a student of charts and technical analysis, I have a Fibonacci drawn from this low to this high, and we're just at the first level. So, and when you're looking at Fibonacci retracements, the the major levels are right in here. Really, the halfway point or the 50% is really not a level. It's just there, but your major levels was right here at 0.382 and 0.618, or the 618 and the 30 and the 382. So we got a ways to go if it gets there. If it's going to bounce, now it can bounce here, but being is that it already touched this level and you can see it push back up and it's back here again testing it. My next level of retracement is down here at 3,800, 3814.54 to be exact. That's my next level of retracement in the S&P 500. So with that being said, I really think that we got some more downward action to go. Now, a lot of people don't pay any of this any mind, but I'm just giving you my take on it. And so with that being said, then I'm gonna be selling all major moves to the upside. So when I get a rally, I'm looking for a way to get in and then get short. One of the ways I like to get short is using credit spreads. So I placed a credit spread in the SPY, which is the ETF of the S&P 500. So I came in today. Now I'm down on the position right now. Well, that's okay. I came in and I sold at the time when I sold it, it was a 24 delta. I sold this right here. You can look over here. You see this W, that means working, working. I sold because I got a closing position. I automatically put closing positions in at the time that I sell. So I sold 441, bought the 447, which is actually, I don't think I meant to go $6 wide. Let me take a look at it just to make sure. Normally I do $5 wide, but that's okay. So I did a $6 wide and I sold the 441, bought the 447. And as you can see, if you were to put this trade on right now, you got a 70% probability of profit and an 82 moving around 80 something percent um, of making 50% of the premium that you collect. And so basically, I just need the market. I don't need the market to go down. It can go down, that'll help. I just need the market to stay below 441. And you can look over here, you see this green line. And so it's past 441. So I make money as long as it stays below this green part right here. And I start to lose at the red part. And then so you may ask, so why is it showing if you go past 441, you still making money? Because you add the premium that you collect to the short strike. The short strike is right here where I sold 441. So you add that 163 or whatever, that's going to put you past 442. So if you look at this on the chart, let's go to a daily. This is a daily chart. So if we go to this daily chart, it's at 442. So that's going to put me right up here above this high. So to be exact, right around this level. So as long as the market doesn't come up here, I'm good. So it can come up in here, hit here, and bounce around. I'm good for the next 31 days. That's just one way of getting short the market. Basically, you get a rally or something like that. You sell into that rally, and you create a short position. And when you look at let's take a look at it on the analysis tab. I'm gonna show you on the curve view what it looks like. So basically, you on Tastyworks, you come over here and click on this tab. I'm going to click on analysis, and it brings it up right here. So now you're looking at it a whole nother way, right? This may be even easier to look. This part here shows you where I make money. The red obviously shows you where I lose money. This flag is where the market is. So I just need the market to stay within this area. And then it shows you like up to date as of right now, I got a 76.8% probability of profit. You see it? And a 23% chance of it getting up around this area and being wrong. And this a update. This actually updates um every day or daily or as the market moves. And so that's putting on a high probability trade and then just letting the market, making the market come beat you. So if you do something consistently where where you're putting probabilities in your favor, then you should win the majority of the time. And then at that point, you have to manage your losers and manage your winners. And so for the most part, those are the strategies that I use selling credit spreads, especially in this market. Now you can also buy dips doing the same thing at a time when you think the market is overextended to the downside. So let's say you could be, now no one knows, I don't know what's going to happen, but let's say you say this bottom right here or right here today, hey, I think this is going to be an up move, right? I think we're going to get a bounce. We got some news this week. We're going to hear from the Fed. Hey, I think this level going to hold and we're going to get a bounce up in here. So you could come in here and you could take the other side. Let's go to, we're going to go back to the table. We're back on the option chain. So let's say I'm going to move to a different expiration so it don't make it look a little different. So let's just go 35. I'm going to go 35 days. Nah, I don't have as many strikes. Let's go 67 days. Let's just say you like, hey man, I think I'm bullish. So you could come out here. Now this is your expected move. You see this ruler? So you could come out here and say, let's come down here and sell the 30 delta. Let's go and then buy the 27. Let's say you did that. Then you collect a $1.19 premium. We'll lock it right there. Look over here. You got a probability of profit is 65%. Probability of making 50% or keeping 50% of this premium, 83. You see it bouncing around just because the market is moving. So it's right here, right around, let's just call it 83%. And so this would be a way of buying the dip without coming in and actually buying shares. And you can see it's only going to margin you $380 because we are defining our risk. Now, if I wanted to take this off and just do this naked, buying power is going to be $5,900 because this is a naked put. Now, something like this, I probably, if I were going to do a naked put, me personally in this type of market, and I come all the way out here and sell one standard deviation. That's just me. And I'd be way out here selling, right? You could sell this, bring in about, let's lock it, $486 premium. Buying power effect is going to be $3,650 that you're going to be margin. And now this is a naked put. So you can see the max loss is $36,000. I mean, that's just going to zero because you did not define your risk. So one is the first one I modeled on this one was a put spread. And now I'm modeling just selling a naked put, which I think is more efficient to do when you want to get long, in my opinion, instead of coming in here and buying 100 shares and buying the dip. As opposed, I would rather just sell a put. And then if you really want to own the spy, let's say for some reason the next 67 days, it comes down and broach and breaches your put strike, and you get put to shares. You can get it at a discount, getting put the shares down here as a coming in and buying it up here somewhere at the current price. So with that being said, I also want to run through some charts on the some of these FANG stocks. Apple, look, like I said, it's already looked like it's retreating and closing this hole, um, closing up this gap. And you can see it. You got a nice support level right here. So if I had to do a little support, this may not be a bad place. Let's see if we can draw a level right here. This don't look like a bad place. If you're a buyer of Apple and you want looking for a place to buy and you want to get long, it's not a bad place. As you can see, you got a high, low, all the way up to here, and you see you got a little chop, little consolidation before it breaks out this level right here. So this is some support. Now, how much I don't know. Like it could, how far it's gonna go up, but that may not be a bad level. I'm not bullish on anything. So, but I'm just saying, dip buyers, this may not be a bad level if you believe if you want to get bullish, if you're a bull. Amazon chart looks nasty. Like I don't see anything. There's nothing in here. There's nothing to see. Like, literally, there's nothing in here that I want. I just think this chart looks nasty. I don't like this at all. But I mean, there's a trade for everything. Look like you got a little head and shoulders action up here, broke the neckline here. You see it came down, pulled back up to this level right here, and then took off. And so now you look like we just got a little consolidation in here. May not be a bad area to sell an iron condor. Um, you got a high IV rank. I just don't like it. Got gaps everywhere. I don't like the chart. Now I will say this: after Amazon does their split, this will become a good vehicle to put place trades in my opinion. Google as well when they split. But right now, I don't like. I didn't even know I had this. You see this little support level I drew a long time ago, and it's holding. Came down to here, boom. Down here, boom. But I will say this: you've had 2 or 3 retests of this area. The next time it comes down here, you're gonna get a flush. I don't think it'll hold 4 times before it breaks down. Microsoft, all the FANG stocks, I think Microsoft, it looks weak. You may get a little pop into here, but I would say that the market will hold until we hear what the Fed is gonna say. So, but I still think Microsoft gonna push down into these levels. You might get a push to here, consolidate, push to here, consolidate, then before you get a final flush. I do think that things are gonna get worse. Tesla's been holding the line, consolidating. Telling you guys right now, if Tesla breaks this low down right around 700 down here, and look out below. You can see it come all the way down here to where you got this gap down here, right around what's that 450. If it takes out this low, it could break down. And then a lot of people, saying because Tesla's is great company. Most of the companies I just went through are great companies. Apple is a great company. Amazon is a great company. I know Amazon knock on your door every week. And they seem like they live at my house. Amazon, Tesla, these are out there. Microsoft. None of these companies are bad. The fundamentals hadn't changed on any of them. So ask yourself, why are they down? That's because at this point, I don't even think fundamentals matter. Fundamentals didn't matter when the market was doing all of this. When the market was doing this, fundamentals didn't matter. Yeah. So fundamentals don't matter now. Fundamentals didn't matter when all this was going on. Look at these, man. Look at these. These stocks are getting killed. The only ones that hadn't been hit yet is what's the ticker symbol for DocuSign? Let me see. There you go. These stocks are getting killed. Look at this. And it's a weekly chart. These weeklies, if you put that's crazy right there. You put this on the daily and look at this. These charts getting killed. Um, you can pick one. Let's look at the Coinbase. Killed. These stocks. Look at Robinhood. This is horrible. This is horrible. Stock's like $11. It's dead. I mean, these stocks like this are all over the market. Look at Uber. Horrible. You can pick any. The only thing that's holding the stock market up right now. Look at SoFi. This is horrible. I remember watching YouTube videos of these guys talking about how SoFi was gonna be the bank of the future. Now it ain't. Things could change, but I remember watching the videos and guys was like they was pumping it. They was pumping it even right around in here, just pumping it, pumping it. They was pumping it, guys. They was pumping it. And they got a lot of subscribers. And I was just like, I don't care about any of those fundamentals. These charts will show you what if fundamentals matter or not. None of it matters. I don't care about any of that stuff. Look at it. I can look at this and tell you now. I show you something else though, where you can look at tried and proven companies like General Mills. Even General Mills is down a little bit the past few days, but as you can see, up, but not up on crazy evaluations. You know, these cereal plants, food plants, like just look at AT&T. That's a bad example. It got hammered. It's back down. But some of your blue chip stocks, which is why the Dow hadn't really taken a real big tumble, which the Dow is tumbling now because the banks are now coming down. Even the banks are coming down. So you see this big gap down by JP Morgan. And I think it got some more to fall. This will be a real make or break level right here in JP Morgan. I like to find the gaps, and those gaps I like to use them to hold basically for support or resistance. And then once it breaks, then it becomes resistance. Here you go. Hey, this level right here, where you can see, I maybe need to move this over some. That level right there, I see JP Morgan coming all the way down to here, where to find support, and then we'll see what it do after that. So me personally, I would not look to buy JP Morgan before it comes down and touches 110. Then you might be able to get a bounce. But yeah, let's take a look in the video. I mean, these stocks look horrible. So I'm not in the business of dip buying and just holding stuff. If I was going to buy stocks, if you are going to buy stocks, I would advise to buy stocks to pay a dividend. At least you're going to get paid for holding the bag. So if you want to be a bag holder, you might as well collect some dividends while you holding the bag. But other than that, my strategy is going to stay the same. Had a little bit of a down day today. I think I'm down about $74 on the day, up a little bit again in this account for the year. But we selling rallies. Every time we get a rally, we're gonna short into it. And I'm not too dismayed about this right here. We'll see how far the market rallies. But like I said, before I decide to do anything, it got to come take me out at the 440 level before I look at rolling or doing anything. defensive to manage the trade. So with that, I hope you guys got something out of it. Hit that like button, hit the subscribe button. And with that, guys, I'm out. Peace.